Thank you, Jill, and hello everyone. I'd just like to start by introducing our panel of experts. We have Todd Juliet, who is Managing Director, Performance Measurement and Analysis at State Street Global Advisors. Tom Stapleton is Head of Performance at Schroders Investment Management. Daryl Crowley is Head of Performance Analysis at Pictet Asset Management. And finally, a man who needs no introduction to an audience of performance professionals, David Spalding, the founder and CEO of the Spalding Group. Gentlemen, welcome, and thank you for joining us this afternoon. In today's roundtable, we will be discussing some of the key findings that were highlighted in a market survey that I completed recently and that was sponsored by BISAM. And as we go through the discussion, do please raise questions for the panel, and we'll ask them to respond at the end of the discussion. Now, as you can see from this slide, this was an extensive global survey involving over 50 organizations representing different types and sizes of investment management firms. And the survey was run in October and November of 2014. One of the points covered in the survey was the challenges facing the asset management industry. We gave the respondents 6 challenges and asked them to rank them from greatest challenge to least. This slide shows you the proportion of respondents that ranked each of the 6 challenges as their greatest challenge. 2 of them stand out: degree of manual processing and providing fixed income attribution. 53% of the respondents ranked one of these as their greatest challenge. So we're going to start today's discussion by talking about these topics. Let's start with the degree of manual processing. But before I ask the panel to comment on the topic, we'd like to get your views. We'd like you to pick one of the options shown here on this poll. Jill.
Thank you very much. And you have 4 options here, and if you could select the most appropriate option and click Submit on your screen, and I can see that we're getting the votes in. And we will be closing the poll momentarily, so if you could select the most appropriate answer and click Submit on the bottom of your screen. Okay, so we're now up to 80% voted, so we'll be closing the poll momentarily and sharing the results with you. And now we're sharing the results. And you can see that the first one is the greatest, it is the greatest challenge facing our team with 8%. It is one of the big issues we face with 55%. It is an issue, but we have other challenges that concern us with 32%. And it's not an issue at all for our team with 5%. So Peter, I'll hand back to you now.
Okay, thanks Jill. Now let's get some views from our panel. Why do they think that manual processing is such a big challenge for performance teams? What impact does it have on teams? And why does it seem to be more of a challenge in North America than in Europe and the Asia-Pacific region? Let's start with Tom.
Thanks, Peter. Well, everyone's challenges are going to be unique, of course, and it's likely only particular elements of processing data within a team is going to be manual, and that's going to vary across the different teams. So it is difficult to generalize, but if I think about manual processing, I'd broadly divide it into two main buckets. So first of all, we've got our data into our core performance application, and I'm thinking here about positions and transactions, instrument level static data, and also market data. And I noted in the wider BISAM survey that only 50% of teams stated they received more than 90% of portfolio data with no issues. So I think that probably ties in quite nicely with the poll we've just seen. And then the second category I think about is the data we're getting out of our core application. Generally, I think this is where we have more complex reporting requirements from our internal and external clients than we actually can produce in our standard reports or straight from our system. Kind of typical examples I'm thinking about here would be bespoke net of fee calculations, for example, or where we need to build a one-off classification structure for attribution reporting for a particular client. We have to manually go in and amend our report. Clearly, if we're getting bogged down in manual processing, then we're going to have high risks of error in performance we're producing. We're going to have increased use of spreadsheets, and we're going to have less time in the team to spend on servicing our clients and less time to focus on projects and process improvements. So how do we solve these issues? Well, for me, I always think about solving the data issues first. Once we've solved our data issues, then we can move on. And good quality data is absolutely fundamental. We mustn't waste our time continually tracing down and solving the same issues every single month before we can calculate returns. So, I think that's about collaborating closely with our colleagues in upstream departments and our data providers, relentlessly chasing down and resolving recurring data issues, and encouraging best practice for data governance throughout our organisation. We need to ensure clear ownership and tracking of open issues, and as performance teams, we mustn't sit there and suffer in silence when we're trying to calculate performance. Then once we've resolved our data issues, we can look at other challenges such as STP rates and the depth and quality of our reporting. And I'd like to end just by noting on a bit more about spreadsheets, which we touched on earlier. I think spreadsheets always will be part of our reporting solution, but there are going to be good and bad spreadsheets, and we need to apply good governance and procedures to spreadsheets. That's both building new spreadsheets and verifying and maintaining existing spreadsheets. For example, we should be looking at periodic reviews across the department to make sure that every spreadsheet we use for core processes is validated on a periodic basis.
Okay, thanks, Tom. What do you think, David?
Thank you, Peter. I just got done calculating composite and portfolio returns across 6 strategies for several years for a client. And I did this manually using spreadsheets, and I have to say it was very painful. It involved a variety of cash flow scenarios, a couple of which actually were so intriguing that we're going to incorporate them into our training class, because I think it would be a challenge for anyone to try to figure out how to calculate performance. And I imagine that a lot of the manual processing that firms are doing today isn't much fun either. You have talented people who have pretty good skills, and yet they're being asked to do a lot of manual work. But the reality is manual processing will always be with us because you're not going to be able to automate everything you do. But manual processing is time-consuming, error-prone, and not a particularly exciting thing to be doing. Unfortunately, it often results in duplication of data, which may become a maintenance issue as well. I think the simple solution here is automate as much as you can. Bringing in the right tools, figuring out what those manual processes are, and wherever possible, create an automated alternative. I think outsourcing is also an option, but I'd say that the jury is out on whether or not it really is a good one. I know a lot of firms are considering it, but we're actually seeing some insourcing, so that says that outsourcing isn't always the best approach. I agree with Tom that good governance is very important. It's necessary. Most firms have very strict policies and procedures as well as controls in place whenever a new program system is introduced. We're going to find testing, lots of checking going on to make sure that it does what you want before you introduce it. The same doesn't hold, though, for spreadsheets in a lot of firms. Anybody can create a spreadsheet, and before long you actually have a new system installed with no controls, and the problems really arise when the creator of that spreadsheet decides to leave. We need to have the same kind of controls in place for spreadsheets too. Thank you.
Okay, thank you, David. Todd, how about you?
I think I would broadly echo the comments that Tom and Dave made. I think the challenges and concerns with manual processes are well known because they've been around for a very, very long time. Certainly, we as an industry have made inroads and progress, and things are generally less manual than they were, in prior times. But for the instances where things still are manual, the well-known challenges and problems, which is being very prone to error and being time-consuming and less efficient, are well known. So exactly echoing what the other folks said, the solution is, in a sense, it's simple, but it's easier said than done. Is to invest in the infrastructure of systems that can do the jobs that are needed to be done, as complex as they may be, and that's certainly growing in complexity. That's the clear trend line that we're seeing now, and I project will continue into the future. And beyond the systems themselves, it's the data, and being able to have the data feed into the systems and tools that you utilize so that the work can be automated rather than pulling all those things from disparate places and then plugging it into a spreadsheet or at least a macro of some type. So that's easier said than done. As I said, it takes a commitment and an investment, but that is clearly the way forward, and the extent to which we can do that as much as possible is the right solution to minimize the problems that come from manual processes.
Okay, thanks, Todd. Darren, you can have the final word on this topic.
Thanks, Peter. I think a lot of the colleagues have already said a lot of the big issues here. One comment I'd like to make, that with manual processing, you can automate sometimes too much and lose the quality. For instance, stale pricing, you might keep the price the same over many months. But if the market's falling 30%, that security all of a sudden is your biggest and best holding because you haven't moved the price at all, because it's just automated to come in the same price. I think we're very good at finding ways to get information in on the securities we hold, the positions we have in-house. But I think sometimes where we do miss some of the manual processing parts is for the benchmark securities we don't own, because not necessarily set up so well on that side. So my comment here really is sometimes it's the holdings that you don't have that appear in your attributions that you really need to look at. Once again, you need to have a quality control for anything manual and for anything automated, because systems change over time.
Okay. So let's now turn to the other major challenge for performance teams, providing fixed income attribution. And again, we'd like to get your views on this before we hear from the panel. So we've got another poll here with 4 options. Jill, can you just run us through this?
Thank you very much, Peter. And again, we have this poll on the screen for you with the 4 options there. And if you could just select one of the radial dials against the most appropriate answer and then click Submit at the bottom. And we will give you a couple of moments to select your response and click Submit. And we can see that the responses are up to 50% so far, so we will be closing the poll momentarily. Just give you another couple of moments to respond to that. And we're now up to just about 80% of you have voted, so I will close the poll and share the results. And the results are: the attribution models that we need do not exist yet is 21%. We have the right attribution models but we don't have systems is 19%. We have the right models and systems but data is the problem is the highest at 38%. And none of the above are the root cause, it lies somewhere else is 22%. So I'll now close that poll and hand back to you.
Okay, thanks a lot, Jill. Interesting that 1/5 of you think that there's something else that's the fundamental cause, and we don't have time to go into that now, but it would be interesting to talk about what that could be. But let's get the views of the panel on this topic. Why does fixed income attribution lag behind equity attribution in terms of the maturity of the service that performance teams can provide? And what we're showing you here is something that came out of the survey that we did last year, and if you just take some time to look at that while the panel is speaking, you can see quite a difference between the level of maturity on fixed income attribution and equity. Anyway, David, let's hear from you first on this topic.
This is one of the ironies, I think, in our industry, because fixed income dominates. There's a lot more money invested in bonds than there are in stocks, and yet bonds seem to always be lacking. I think the chief reason is because of its inherent complexity. Equities tend to be a lot simpler to deal with. Fixed income isn't. The types of instruments vary considerably, and even some of the things we do with them are complicated, like calculating accruals. The math is much more intensive, more complex, more extensive when we're dealing with bonds. Also, there's a lot more data that we have to account for. So there's a lot of reasons, I think, that make addressing fixed income a challenge. fairly easy to come up with an attribution system for equities, not so with fixed income. But there is some good news. I think we've made a lot of progress over the last 10 years. There are a lot more packages available. But unfortunately, we don't have any common packages. For example, on the equity side, as the survey mentioned, 95% of the participants are using one of the Brinson models. On the fixed income side, there is not a common system. Now, the survey did say something to the effect that 47% use a duration analysis method, but I think that's a generic term that could actually apply to multiple models, that there is not one model that meets that. Whereas with Brinson, well, okay, we do have two different models, but they are common across all. Another problem is that one model often doesn't do the trick. GRAP, which is a French group that met more than 10 years ago and addressed a number of things, one being fixed income attribution, concluded that most asset managers should have two models, one for internal use that provides a lot more robust and complicated math, and another one that's a little bit more basic to provide information to clients. Thank you.
Okay, Tom, what are your views on this topic?
Well, I was thinking about the question, is fixed income attribution less of a chore than for equity, or for me, is it just harder to achieve the desired result? I mean, it's very interesting to see that poll result just then with 38% saying that the data is a significant problem. When I think about fixed income attribution, I think it's the analytics that are so much harder to get right than for equity. Equity analytics, where we need them, are typically driven by publicly available balance sheet data and easy to obtain. Equity attribution also typically requires a small amount of analytics anyway, because often we're only looking at, say, country attribution or sector attribution. So it's not typically a significant issue for performance teams, and I think we'd see a very different poll result if we asked about equity attribution. On the other hand, fixed income analytics, they're less consistent in the calculation method behind them. They're more opaque in terms of what calculations are going on from the vendors, and we see a wider variety of data output if we compare the same analytic across different vendors. However, unlike equity attribution, fixed income analytics are absolutely fundamental in achieving accurate attribution. And then on top of that, we typically see a lot less tolerance for residuals in fixed income attribution that we're producing, typically because alpha is lower in fixed income versus equity. So people want to tie it down to within 1 or 2 basis points, where we often might be talking about 5 or 10 basis points in equity attribution. So there's much more sensitivity to those differences and issues in the analytics. And this is especially compounded where we're using different analytics source to the pricing source for a particular benchmark. I think my only other comment on this topic is that compared to the equity index providers, the fixed income analytics vendors have typically been the investment banks historically. These investment banks probably have a bit less incentive to focus on the data quality and the client service compared to the specialist equity providers such as FTSE and MSCI, although I think this may be starting to change as we see investment banks starting to divest from this area of their businesses.
Okay, Darren, how about you?
Yeah, I think the thing here is often the level of detail required and the time and data needed often clouds the outcome. I mean, the outcome has to be in a few basis points. For equities, it's you're looking at a lot more excess return to explain. So the quality of data and the depth you have to go in. For instance, the indices have a lot more constituents for bonds. You might have to map many non-benchmark holdings, bonds that you own, and then you've got to get all the data analytics around that. I suppose my kind of frustration on fixed income attribution is often that the residual or the other or the price excess return is often the largest excess return that you're calculating. And I think sometimes for clients this generates more questions than it answers. But the bottom line is it's a lot more data intensive, and the answer is sort of a few basis points, so you've got to be a lot more accurate.
Okay. Finally, Todd, what would you like to add?
I guess I would just say that surely there are a lot of data methodological questions and issues that the other folks have commented upon. A different aspect to it that enters my mind is the fact that clients don't seem to be clamoring for it all that much. and I think if they did more, now surely there's a demand, and it's relatively commonly requested, but it's not as unilaterally requested as equity attribution. So we can debate whether it's cause and effect, but I do believe that if there was a larger upswing of demand from our clients and their consultants, that we would redouble our efforts to move things forward regarding the methodology and the data issues that have been already cited. Now, I'd hate to project, why clients don't ask for it. Maybe because it's more complex, it's harder, it's arguably mind-numbing when you get into the depth of the math that a lot of those folks maybe don't want to dive into as deeply, so they don't get hung up about asking about it. Or there's a part that makes me wonder, it's just not as sexy to talk about. Nobody talks about bonds at cocktail parties, whereas it is more common that people want to talk about the stocks that they own or what they think about them. It's easier to have that type of dialogue at times, and more interesting because it's more interesting in a sense asset class for most people to talk about. But there's still an opportunity. I think we have come a long ways over the last decade or so in terms of moving forward in the fixed income attribution and analytics space, but surely there's more to come as well.
Okay, thanks, Todd. Actually, I must go to different cocktail parties to you because we're always talking about bonds, the ones I go to. Anyway, so let's move the discussion on now to look forwards. The survey revealed an industry landscape in which performance teams seem to be doing okay today, but there are some pressure points. And that raises a question, in my mind at least, about how well performance teams are positioned to face the future challenges. Should we feel optimistic, or should we be concerned about the next 2 to 3 years? Darren, let's start with you on this one.
Peter, for me it's not difficult or rosy. I think it's exciting times. I mean, what we try to do is we've split out the performance measurement role and the performance analytics role, and we certainly want to concentrate more on the analytics. I still feel that we need more simplistic analysis rather than getting lost in all the jargon and the complexity of all the data we have. I think it's our job to communicate. Are we making good investment decisions for the clients? Are they happy? Are they making money after fees, of course? I think we can produce more data than we can consume or have time to understand, so we've certainly got to learn to summarize more. I think over the next few years things will change. I think the way we provide information will have to be more concise. I think if you look in the modern world, and for instance what my sons are looking at, it's all very concise, it's all very simple messages where they can move across. And I think what we need to do is, rather than produce that 100-page report that has every detail everyone needs, I think we need to provide some kind of summary, direction, conclusion. The reports we have to provide have to come up with key topics, and they have to follow the investment process and what we've seen from the investment process.
Okay, thanks, Darren. Todd, what about you?
I think I'm generally a cautiously optimistic type of guy, and so I'd say my views kind of correspond to that. I think there's a lot of really, really awesome things that we're going to have the opportunity to do in the coming years, but there are challenges, undoubtedly. I think there are increased expectations and desires for what performance and analytics teams provide. Both the complexity and the depth of what's being sought from our internal and our external clients, so the folks with whom we work, our investment teams, our distribution channel folks, as well as, for sure, our clients and their consultants and so forth. So a lot's being asked for. The more that we can automate, the better we'll be able to do that. It's hard to play catch-up. We've been in a past where we have had to do things in a manual fashion in some instances. It's harder to catch up and automate it when we're being asked to do more in the complexity of it, and that's increasing. But it's imperative that we do so despite the cost, and there always is that challenge of the increasing cost of data and the need to invest in systems. We all have budgets that we have to meet, and it's hard to do that, but we really need to, in my mind, invest in the infrastructure of our firms as it relates to performance and analytics to be able to provide what our internal clients need and what our external clients want and need as well.
Okay, thanks, Todd. Finally, David, what are your thoughts on the next 2 to 3 years?
Well, the first issue, I think, has to deal with technology. And Sunday is Easter, and just to quote Jesus for a moment, he said something like, the poor will always be with us. And technology is always going to be with us, and it's always going to be a challenge. I think if we were to have this webinar in 30 years, it would still be an issue because technology is always going to be evolving, and so keeping up with those changes will always be a challenge. How we deliver information, how we store or process information will always be with us. But my greatest worry has to do with probably with risk measurement. That how we're going to measure. We think we have our arms around it, and then the market does something unexpected. We thought back in the 1980s that we had some controls, and then we have the problem. And every so often we get something. The most recent one being in 2008, and a lot of firms thought value at risk would provide the kind of information they needed to have better control on risk, and it turned out VAR was not the panacea, and so that created a problem for us. I think that we need to have the right tools, the right knowledge in place so that we can handle what lies ahead. I think the CFA Institute CIPM program is a great way to have the right people in place for us, but there's a challenge with those people, retaining them, and that will always be with us as well, especially when the market improves, which we're seeing now, and I think there's going to be an increased demand for good people, and that creates a challenge for institutions, and especially because today it's not just asset managers that want good performance and risk people. Asset owners do as well, custodians, software vendors, and so on. So there's going to be a continuous demand for these people, and so how do you find them? Again, I think the CIPM program is a good way to educate people because we're going to continue to have a need for skilled people on staff.
Okay, thanks, David. And Tom, finally, what are your thoughts on this? Tom?
Oh, sorry, I was on mute there. Somehow I went back on. Sorry, Peter. I thought you'd forgotten me, actually. So, gazing into the crystal ball, Peter. Looking back over the last few years, I think we'll see an extrapolation of three main trends we've seen, continuing into the next 3 years. The first one would be just the volume of data we're having to support as performance teams. We're capturing more daily performance. We've got more sophisticated tools, and we're just building up bigger and bigger data sets, and especially as products get more complex as well. I think I see our institutional clients especially getting more sophisticated and demanding in terms of the depth of requirements they have on the performance reporting they want from us. And lastly, we see ongoing pressure to deliver performance to have a faster deadline. So I think I'd sum it up as more volume, more depth, and get it done faster.
Okay, that's great, thanks. And now we'd like to get your views on what you think about the next 2 to 3 years. Are you optimistic or concerned? So Jill, can you just run us through this final poll, please?
Thank you very much. And here is our final poll for today. And tell us what you think about the future. And if you could just select one of the two answers. And when you've made your selection, please click Submit. And we've just coming up to over 50% of you voted, so we will be closing the poll momentarily. And if you could now make your selection and click submit, and then we will be able to share the results with you. So we're up to over 80% of you have voted now, so I will close the poll and share the results. And the results are, we're heading for difficult times in the next 3 years, 41%, and everything will be fine, I'm not worried, for the next 3 years, 59%. So I'll now close that poll and hand back to you, Peter.
Okay, thanks, Jill. Well, there you go. Two-thirds of our, just about, no, not two-thirds, 60% of our audience are optimists, so that's great. Well, we're getting close to the end of the discussion now, but before we ask the panel to respond on some of the questions that you've been asking, I want to give them the opportunity to briefly raise one point that they think is key and that we haven't discussed so far. So, Todd, let's hear from you first.
Yeah, I guess my overriding theme, and we've touched upon it a bit, but not as directly, is that in these coming several years, I think we have a phenomenal opportunity to positively impact the industry, both our firms and the companies that we work for, as well as our clients, because of the needs that they're having that are increasingly complex, and we have the capability and the knowledge and the tools, by and large, to provide those solutions and provide that information, and even more importantly, the insight that they need. Insight being, beyond just providing data and numbers to people, but providing the insights based on the knowledge and our ability to interpret it and analyze it and convey key points in a succinct manner. And we're well positioned, and that is our opportunity to add value and make headwinds and benefit our firms and our clients simultaneously.
Okay, thanks, Todd. Darren, what about you?
I think we should try and experiment a bit more with some of the reports we produce. Don't produce the same reports that seem to be common across every organisation. Go and speak with the senior management, try and find out what information they would find useful. Is it by teams? Is it by desks? Is it by strategy? I think what we could do is we could look at a lot of ways, different ways of showing the information and explaining the information. We try and produce new reports all the time. Sometimes they don't work, and sometimes they really go down really well. But I think that's a bit of a challenge, to look how the reports can affect your organisation. Maybe we'll end up working on something like, I don't know, more on trade cost analysis, why you bought a particular stock, why we sold a stock, what news flow came in to make us make that decision. So I think if you've got a report that can actually show the decision-making process, I think that's a unique way going forward of explaining performance.
Okay, thanks for that. Tom, how about you? What point would you like to make?
Well, I'm glad there was 59% of people not worried about the next few years, so I'll bring up a topic that maybe we all should worry about a bit more, and that would be regulation. I think we've obviously seen a significant increase in regulation across the whole asset management industry since the financial crisis in 2008, but with a few exceptions such as AIFMD and KIDS, for example, in Europe, we haven't really seen regulatory impact on performance teams adding to the burden of what we have to do day to day. I think we have to be careful, because otherwise if there are errors and malpractice, we could easily see the regulatory lens turn on us. Certainly benchmarks are a hot topic amongst regulators at the moment, and there's a EU vote on this imminently. We're very privileged to have GIPs in our segment of the industry, which are obviously ethical, voluntary standards and globally recognised, but we have to be extremely careful not to take that for granted.
Okay. Thank you, Tom. Now, David, I've known you for a long time, and I know that you really do like to have the final word, so I'm going to be kind to you for once and let you have it.
Well, you're very kind. Well, now that I have control of the microphone, I'll be brief. To me, multi-currency attribution is something that needs attention. Your survey said that about 22% of the respondents are using Karnofsky-Singer. Now, that doesn't mean that only 22% are doing multi-currency, because there are other models, but I'm concerned that not enough people are doing multi-currency attribution. Too many are relying on a fundamental attribution system, not taking into consideration currency, even though they're investing across other countries. And so that, to me, is a concern that people should be thinking about. Thank you.
Okay, thanks very much. Now, a lot of you have been asking questions, so let's get some responses from the panel. Yeah. So, Jill, do you have the questions there?
I do, thank you very much. And our first question here today is, how much or little manual processing should we aim for?
Let's give that one to Tom.
Thank you so much, Peter. Well, I mean, it's the how long is a piece of string question, isn't it? I mean, I think where we know the requirements, where they're nailed down, where we've been doing the same thing year in, year out, we should aim for zero manual processing. I think where manual processing is acceptable is where we've got changing products, changing client questions, and changing requirements.
Okay. Todd, is there anything you want to add to what Tom said there?
I'd say it's a case where you target and strive for zero, realizing that in reality you'll miss that by some bit, but if you don't aim for it, you'll never even come close to hitting it.
Okay. Now, I've got one here. Before I ask Jill for the next one, this one was actually submitted in advance of the webinar. That's how keen this person is to get the answer. So basically, for many funds, the return is calculated net of fees, and for mutual funds, that's usually the official number. So when including attribution analysis results alongside a net of fees return, do you think we should include fees in the attribution analysis in order to get the overall view on attribution, or should we exclude fees because they're not part of the investment portfolio decision-making process? So should the attribution relate to the gross return or to the net return? David, what do you think about this?
Well, I think ideally you would want to be using that, but the challenge is how you take that fee and allocate it across the various sectors and securities and so on, and I think that would be very difficult to do. So to do it gross, it should be fine. If you think about it, in most cases your fee is charged at the portfolio level, and so what is the benefit to try to obtain attribution net? I think if you know what your gross return is, what you're really trying to do, right, is determine where your excess return came from. And to me, it's a lot easier to do a gross fee than net. So although I could see interest in doing it net, I think actually making it happen could be very complicated.
Okay. Jill, how about the next question that came in during the webinar?
Thank you, yes. And our next question is, would any of the panel like to comment on the state-of-the-art best practices? Read the number 3 issue, strategy-based attribution.
Yeah, so that was the in the poll, that was the one that got the 3rd highest number of greatest challenges. Darren, what do you think about strategy? Having performance returns and analysis at a strategy level rather than a portfolio level.
Sorry, I'm a little bit unsure. Do you mean the strategy of the portfolio, or do you mean strategies within the portfolio? For instance, I don't know, an alternative portfolio which might have many strategies going on for an absolute return product.
Yeah, so that latter one. Yeah.
Well, if you've got different strategies, say an event-driven absolute return portfolio, it's grouping together securities in a unique way to your firm. Now, the problem with that is you need to know exactly why the fund manager has bought those stocks, long or short. And without knowing their classification or their mapping scheme, that's going to be very, very difficult. So that you can't go to MSCI, you can't go to any kind of index vendor to get that. You've got to get, as soon as they buy the security, you need them to tell you, to mark in some way what strategy or basket of stocks it belongs to. You don't want to do this after the event, because if you're doing that after the event, you might end up putting it in a different place. So it's very, very key that when you buy the stock, you then map the strategy it belongs to. Sometimes, though, you can even buy the same stock in multiple strategies, or you might buy futures to cover multiple strategies. Then you've got to split one holding in many ways, and that's where it gets very, very difficult, Peter. It can be done, but it needs information right at the start of the chain.
Okay. Jill, next question.
Lovely, thank you. And this is our last question that we have time for today. If fixed income attribution is not on the minds of the clients, what is?
Well, I think maybe we'll ask each of you to respond on that, but briefly, as we're running out of time. Todd, let's start with you.
Yeah, I think what's on their mind at a high level as an asset owner who's responsible for, you know, a pension fund, a sovereign wealth fund, whatever investment pool, it's asset allocation and matching those the assets to their liabilities. So that's a very global macro view. It doesn't have as much to do with performance, although performance and analytics feed into that. But I think that's their focus at a high level, and in various degrees, the analytics that we provide help inform them on how to match those assets and liabilities so that they meet their requirements down the road.
Okay. Tom, what do you want to say on that?
Yeah, it's hard to say because they're all different, obviously. But I think fundamentally, clients are asking: are there active managers for certain adding value, and are we doing what we say we're doing and carrying out the strategy as intended by the client or the consultant? So, you know, that may be attribution to answer that, but it's often a lot simpler question to answer, and it's going to depend on the strategy and depend on the way we're managing the portfolio.
Okay, thanks. David, how about you?
I'm sorry, who did you ask?
David, you.
Oh, okay, good, thanks. Okay, I didn't hear it. I apologize, but I think it's the wrong question. I think the question has to be, if it's not, why isn't it? Because it needs to be. Clients need to know about fixed income attribution. If they're not asking for it, they should be. They should be wanting to know, how did you do that? It's a simple question. You told me what your return is. You told me how you did relative to the benchmark. Maybe you told me what your risk level is. But I should be asking, how did you do it? And that has to be a question that's asked. And if they're not asking it, they should be. And if they're not asking it, then the asset manager should be telling them anyway. Because the asset manager should be communicating how I did it. It's a very, very important question. And so it's not what should they be asking. No, they should be asking for it. And if they're not, you should be telling them.
So I think, kind of paraphrasing what you said, David, basically people shouldn't invest in something if they don't understand it.
And if they are investing, they want to know, you know, how'd you do it? Because, oh, well, look how well I did, and you sold me on you have a skill. Well, then prove that skill is working, and it's not because of dumb luck. And that's really where attribution is critically important.
Okay, Darren, final word to you on this. If clients aren't thinking about fixed income attribution, what are they doing?
I think they should be asking lots of questions of us, in so much as, you know, are we managing the money well? Are we following all the client guidelines they're giving us within the risk parameters, all the usual stuff? But I think what's really important is that if we sell a particular strategy, that we actually manage the portfolio to that strategy and we don't change over time. We've been hired for a particular reason because we manage money in a particular way, and we should have all the reports and the analysis to be able to explain how we've managed that portfolio, how it's changed over time, and how we've managed it following their guidelines. I think it's quite simple. We just need to deliver what they want us to deliver.
Okay. Well, thanks very much. Our time is up, unfortunately. We were not able to answer all the questions that were asked, so we will follow up on any questions that were raised but which we were not able to answer during the webinar. So I'd like to thank you all for joining us today. I'd like to thank the panel for giving up time from their busy schedules and for making the roundtable so interesting and enlightening. And of course, I'd like to thank BISAM for sponsoring this event. Goodbye, everyone, and I hope you enjoyed it as much as I did.
Thank you very much, Peter. And I would like to take this opportunity to thank all of the panelists and thank everyone for attending today's virtual roundtable on investment performance analysis. Once you leave today's webinar, you will receive a survey on the presentation, and we would appreciate it if you would complete that and provide your feedback. You will also receive a follow-up email within 24 hours with a link to view a recording of today's webinar. On behalf of BISAM, PK Consulting and our panelists, thank you for joining us today, and please do enjoy the rest of your day. Goodbye.